If you have invested in an IPO before or are planning to invest in Hyundai's upcoming IPO, or for that matter, any IPO, I'm sure you have been curious about how allotment works. As an investor, it is a little important to know how all of this works behind the scenes. So in today's video, let me break down how IPO allotment exactly works in extremely simple words. Look, when a company goes public, it issues shares that are split into different categories of investors. Institutional buyers typically get 50%, retail investors get 35%, and high net worth individuals or HNIs get 15%. But in case the company has not been profitable over the last 3 years, this allocation changes a little bit. In this case, institutional buyers get 75%, retail investors only get 10%, and HNIs remain steady at 15%. Now, the number of shares an investor receives in the IPO depends on the demand within each of these categories. If the demand in one category is low, any leftover shares can be reallocated to a different category which has higher demand. Now, on the other hand, if the demand is higher than supply, things get a little more complicated. I'll focus on retail investors here, which is where most of us fall into. Like I mentioned before, a portion of these shares are reserved for retail investors. The number of shares you can apply for depends on something called the lot size. To put it very simply, a lot size is the smallest number of shares that you can buy in one go. In the Indian stock market, one lot is typically worth around 15,000 rupees. I'll use an example to make it extremely clear for you. Assume there are 1,000 shares available for retail investors in an IPO and the lot size is 10 units. This means there are 100 lots available, which is basically 1,000 divided by 10. As simple as that. If the IPO is undersubscribed, every retail investor will get at least one lot. But in the more common scenario nowadays, which is when the IPO is oversubscribed, the allotment process moves to a lottery system. In this case, the available shares are spread out randomly by selecting investors who will each receive one lot minimum. For high net worth individuals or HNIs, the rules are very similar as well. HNIs are split into two categories. First category is those investing between 2 lakh rupees and 10 lakh rupees. And the second category is those people who are investing more than 10 lakh rupees. Now, the shares which are reserved for HNIs are further split between two different groups. One third is for smaller investments, which is basically 2 lakh to 10 lakh rupees. And 2/3 is for larger ones, which is above 10 lakh rupees. Now, in these scenarios, if there are still leftover shares after everything, they will be allocated on a pro rata basis. But talking about pro rata, institutional investors get all their shares purely based on pro rata. But we'll leave that for another discussion. So all in all, in short, whether you are a retail or an HNI investors, your chances of getting shares in an oversubscribed IPO come down to a bit of luck at the end of the day. The system is designed to spread shares as fairly as possible in order to give a wide range of investors a chance to participate in the markets.